the U.S. economy is doing fine when you look at the inflation data that everybody was so hopped up on today. But that is not the normal. In fact, we're about to get economic data just today, mere hours from now, that paint a very different story in what is the world's second largest economy, China. This is what we're talking about today here on Macro Money. I'm Ilya Spivak, head of global macro at tastylive. And what we're going to be focused on is the increasing significance of the divergence between these top two global economies and what it means going forward. And of course, attempt to arrive at a place where we can have an actionable strategy to trade it. So the key question then is really that. How do you actually trade as these economies that have been attached at the hip seem to pull apart? And what does that mean? And also, what is the data here that could be a trigger to actually turn it into something that moves markets? At the very least, moves markets further. Because, of course, one might argue it's already moved markets to some extent. So, the first piece of data on the menu here, official Chinese PMI numbers. These are coming from China's Federation for Logistics and Purchasing, which is essentially an arm of the government. It works in conjunction with the National Bureau of Statistics to produce this PMI survey, very much like the PMI surveys we're familiar with from S&P Global, and not quite as tilted towards smaller enterprises like the other Chinese PMI survey, the private sector one. This one coming directly from officialdom and really focused on large enterprises in China that tend to dominate and have a state-owned element in them. So an important indicator here to see what's going on with the business cycle in the world's second largest economy. And if we look at the expectations, they look not great. So take a look here and we see that there is generally anemic conditions in the manufacturing sector. This is, of course, operating on the familiar logic of PMIs. So 50 is neither growth nor expansion. Below 50 is contraction. The further you go below 50, the faster the contraction. Above 50 is growth. And the further you go above 50, the faster the growth. So looking at what we have here, still anemic on the manufacturing side. That, of course, is a very important deal for China, much more so than some of the more developed economies where manufacturing has taken an increasing back seat to services. In China, manufacturing much more important because that's what reflects the vigor of its export engine and that key role that China plays as still for now, although its role is diminished, the go-to value add center in the global supply chain. So inputs like raw materials and semi-finished goods come in. China applies what is, for now, still its most ample resource, labor, to getting these things more finished and shipping them on either to where they're going to go through final finishing or just to end demand markets. And China has been that middle step of value add manufacturing for the overwhelming majority of global trade for quite a while now. And so, or at least the largest node by far. What we find is that in the wake of the COVID pandemic, China has very pointedly lost a step. And you can see that in how anemic this red line has been. Marked on the chart is December 2022, when China began to phase out its zero COVID restrictions. And what you find is there is, of course, a pop in services because you let people out of lockdown. They start to go buy things. But manufacturing only blips higher a bit then settles into contraction territory where it's been essentially since the beginning of last year, give or take. And the expectations on these numbers about to come out is that the pace of contraction in manufacturing will actually accelerate in February. Now, on the services side of things, we're looking at a situation where you did have that catch-up pop, but it fizzled very quickly. You can see the peak there already there by March 2023. And since then, we have seen a slow but certain grind lower. And what we are expecting for February is that the pace of growth will continue to slow after a brief, shallow upswing in January and give us near standstill on Chinese service sector performance, 50.5 expected, so half a point off just idle. Now, this, of course, is going to contrast significantly with analog numbers we're expecting, again, over these next 24 hours out of the U.S., in this case from the Institute of Supply Management, one of the key ways that we get PMI data out of the U.S. And here, we still have that anemic manufacturing story. Manufacturing still in contraction territory in the U.S. and expected to stay there at 49.5. But as we can see, it's very clearly rounded a bottom, and the pace of contraction has been easing steadily for months. This, in fact, is going to be, if expectations hold, that is, the slowest pace of contraction and the closest we've gotten to arresting that contraction since the contraction began in April of 2022. And so as we look at this then, March, incidentally, was standstill of 2022. So that was sort of the transition. So as we look at this then, what we find is a very different story, because for the U.S., first of all, the spread between services and manufacturing is much more tilted toward services. It is a much bigger share of the U.S. economy than services are a share of China's economy, because China is obviously reliant strongly on its export engine for a significant contribution of growth, whereas in the U.S., growth is overwhelmingly powered by domestic household consumption. And so what you're looking at here is a very different story. A slight slowdown on the services side expected, a very mild downtick, but the overall story still very much encouraging. What we're looking at here is a situation where the service sector hit the fastest pace of expansion in 4 months in January, and this will be just a slight step lower from that. By the way, I should correct the record here. That's October of 2022, not April, that the manufacturing sector in the U.S. stopped growing, and November that it actually began to outright shrink. So note that if you're keeping score. But nevertheless, the story is obviously much more encouraging. You put these things together and you get a U.S. economy that isn't quite growing as fast as it was in the COVID catch-up phase in mid-2021 or going into 2022, but is holding up meaningfully well, considering the service sector is doing the heavy lifting by far, and it's been relatively well supported essentially since the beginning of last year. It's come down, but it's stabilized at a level of growth that is certainly an enviable setting when compared with what we're seeing in China, where we're hugging the 50 mark and struggling to get anywhere beyond it now for the better part of a year. So the key question, of course, is now what all of this means and how likely it is that these numbers register in line with what these expectations show. Because the underlying story is here of a US economy that's pulling away and a Chinese economy that's increasingly stuck in the mud. Here is the economic surprise index from Citigroup that we like to look at. This is covering China. And what we find here is that from about November of last year, the index has basically stuck at zero. What that means in this context is that if you look at the first half of last year, there was obviously a lot of optimism around China's reopening. And so you can see as that reopening fails to deliver, economic data outcomes fade relative to forecasts. By around mid-year, it starts looking like maybe those forecasts are more pessimistic. They've been downgraded a little too far. And so you get a little bit of a claw back in terms of Chinese data performing relative to forecasts. But then in November, things flatline. And they flatline around zero, which essentially means that Chinese economic data outcomes are tending neither to outperform nor underperform by a significant margin. So analysts' models, when they generate forecasts, seem relatively well tuned to what's going on in China's economy, which would give us the sense that these PMI numbers are likely to come in reasonably close to expectations. They're not likely to deviate strongly. That is a very different story from what's going on in the US. Here is the US version of the surprise index, and obviously we can see here quite clearly when we look at the way that US economic data has transmuted into Fed policy expectations that we've done better for the most part relative to forecasts. You can see that right here. So here's that zero line, that same level where Chinese surprise index data seems to be stuck at. We very clearly pushed off that level where the data is now outperforming or tending to outperform. And we've seen that show up now in GDP numbers, NFP numbers, CPI numbers, on and on and on. JOLTS, jobs openings numbers, the U.S.'s own PMI numbers by way of S&P Global. So on and on, we get a sense of a U.S. economy that is doing better than expected. And what's interesting about this is that it seems to be going from strength to strength, because much of what this downswing was about was expectations for U.S. growth rising. The U.S. economy already behaving better than anticipated, and so expectations going up and the bar to beating those expectations then rising, making it more difficult for U.S. economic data to outperform relative to forecasts. Well, now it seems like the economy is stronger still, and those forecasts need to adjust higher again because we're, again, doing better. This, of course, has been a key input into the relationship we've been talking about between stocks and Fed policy odds. We'll get there in just a second. But first, let's take a look at how that appears to be developing in China, because surely an economy that anemic is going to demand some degree of stimulus. And China certainly has tried. It's cut rates a bit. It's lowered reserve requirement ratios for banks, allowing them to have more money to deploy and keep less on their books in a bid to stimulate growth. It's attempted to offer direct liquidity injections into financial institutions. It's attempted to come out and tell its sovereign wealth fund to buy stocks outright to try to boost consumer confidence, among other things. And yet, if we look at this Bloomberg credit impulse, we find standstill. So what this is, the way that this credit impulse works is, this is an index of the share of new loans as a fraction of GDP. And what you typically see when you want to boost economic growth because there is some kind of an issue is authorities move to make borrowing easier, to make money cheaper, to try to stimulate growth. You can see that right here. So the 08 recession, there's a sharp rise in new loans as a share of GDP because on the one hand, policymakers are loosening the purse strings and making it cheaper to borrow. And on the other hand, GDP is, of course, being hurt in a recession. So the numerator in the fraction is being encouraged higher, just as the denominator is moving lower. Not surprisingly, then, this credit impulse index surges. You see something very similar during COVID, albeit with much less vigor, and perhaps that explains why now we find ourselves not going anywhere, despite the fact that Chinese authorities are trying to deliver at least some amount of policy support. So what you, in fact, find is every time you got to a significant low, you rebounded. But not here. Now we're just flatline. So whatever stimulus is being offered to this very anemic Chinese economy at the very baseline level does not seem to be stoking lending. That is a very different story for the U.S. As promised, we're going to talk about the relationship here to stock markets. But what we see here is that even with the U.S. economy, as we just saw, doing reasonably well, the Fed is still expected to deliver 75 basis points, give or take, in rate cuts this year. Now, that's, of course, down from the 150 or so rate cuts that were expected at the start of the year, as the Fed signaled in the waning months of 2023 that it's ready to begin to reverse policy tightening. But it's a very different mix of things where in China, you have a struggling economy and stimulus that's insufficient to do anything and seemingly isn't working. Whereas in the US, you have an economy that's already doing better, about to get lower borrowing costs so that the better is sustained, or at least that's the hope. At the very least, what you have in the US is policy that is pointedly aimed at boosting the business cycle at a time when that business cycle is already looking better than what's happening in China. So the direction of travel for these two economies is seemingly on an increasingly divergent path, where China is in pain and is struggling to take its medicine and for that medicine to do anything. And the U.S. economy is not nearly in the same kind of acutely negative situation. As a matter of fact, it is easily doing better than any other major economy, bar none. And it's going to get a bit of extra juice, albeit less so than we thought, let's say a month and a half to 2 months ago, from a degree of Fed easing. All of which seems to suggest that the U.S. will continue to outperform, it will continue to pull away, and China will get increasingly left behind. Now, naturally, the question arises, well, how do you trade that? Chinese stocks have already fallen a lot. And we now, as we've just mentioned moments ago, have had a directive from Beijing for the sovereign wealth fund's investment arm to just go and buy them. Also, China doesn't exactly have free-flowing capital availability across its borders. Capital controls are quite significant. So you would need to think about their capacity to essentially force their markets higher. So if you wanted to bet that China is going to keep weakening by taking a bearish view on their stock market, you would be fighting local authorities who have the benefit of keeping capital from pouring out of their borders and who can essentially mandate local authorities to just prop up the market and buy it in what is essentially a closed loop. By the same token, as we can see, U.S. markets have been going up for quite a while. So there's already a significant amount of outperformance here. And now the question is more, well, what else could happen? What else is going to go right here that isn't already priced in? Now, that doesn't mean that stocks are going to fall tomorrow or the day after or the day after that. But what it does mean is that the risk-reward consideration to trading this mounting divergence and probably lingering divergence through stocks, at least here, doesn't look particularly attractive. To trade it, you would have to fight Beijing on the Chinese side and attempt to chase what has been already a very explosive rally going on 4 months on the U.S. side. But there is a better way. And that comes, as ever, from my favorite, the currency markets. Here we have the Australian dollar. This is 6A futures, which is essentially the Australian dollar's exchange rate against the U.S. You can see it's already been going down since the beginning of the year. The dollar has, of course, strengthened. That's not surprising. We've been, as we just saw here on this chart, shedding rate cuts. That makes the dollar's yield profile that much more attractive. So it isn't surprising here that the dollar has strengthened against the Aussie, as it's strengthened against most of its major counterparts. Where the Aussie is particularly leveraged to China is, of course, China is Australia's largest trading partner. And so Australia is very sensitive to China by way of demand. And so the business cycle that we see in China oftentimes echoes in Australia by way of strength or weakness in its critical mining sector. Australia's business model for a few years now has been basically to dig up everything that's available and ship it to China, where demand has been rabid. So if there's weakness in China, you might expect weakness in Australia for that to undermine inflation in Australia and bring on rate cuts. Incidentally, we saw inflation data in Australia miss just this week, in fact, over the past day, which aborted this attempt to rebound off the low around 64.50 and pushed us through whatever this inflection zone is. For whatever reason, whether you choose to believe in technical analysis or don't, or whatever brand of it, it's certainly unmistakable that there was an attempt to break above this that failed multiple times. And once you broke above it, there was an attempt to break back down that failed multiple times. So whatever is going on in this area, it does seem to be some kind of an inflection zone. We attempted to break back above it, failed, and fumbled back through. So there appears to be at least some actionable indication here that the Aussie has bearish potential for follow-through. As a matter of fact, you can see we retested that area just over the past day and pointedly failed. So if one wanted to take a view that the U.S. will continue to outperform as China lags, the Aussie represents much better risk reward, in my view, than you get in either Chinese or U.S. stocks, and with some confirmation that momentum is on your side. And that is macro money for today. I, of course, make no secret of having already held a 6A short for quite a while, so I'll just continue. We're here, meanwhile, Monday through Thursday. So this is the last show for us for the week. We'll be back next Monday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan. I'm back on with Chris tomorrow, though, for Futures Power Hour. On with Tom and Victor for First Call on Sundays, and opining on the platform formerly known as Twitter at Ilias Pivak. Thanks very much for joining. See you next week for this show and tomorrow for Futures Power Hour.